Hello and welcome to our final discussion ahead of the big event on Monday, which is the Union Budget. After seeing a stupendous crash, almost 40%, the Indian stock market rose phoenix like, much like many other global markets, fed on enormous liquidity to actually recover all those losses, and it went on to scale new highs. Does the market depend on the Union Budget as an event, or has it moved beyond that? What will it look for in the minutiae of the budget document and in the headlines, indeed, that will enable it to stay in its sweet spot? More importantly, what's the macro side looking like, and what's the fixed income market wary about, one that hasn't had, frankly, a really great run through all of 2020? Much to discuss, and an important day to do it given the context of how much the market rallied and has lost over the last few days. There seems to be a bit of nervousness in the system. Joining me to talk about all of that is a wide range of panelists today, from macro to the micros of the stock market. So let me introduce the faces that will be chatting with me today. Vetri Subramaniam, who's head of equity at UTI. Neelkanth Mishra, who's India strategist and looks at the Asia Pacific region at Credit Suisse. Pranjul Bhandari, chief India economist at HSBC, and R. Sivakumar, who heads fixed income at Axis Mutual Fund. Welcome to all of you. Thank you for joining in. Neelkanth, first word with you. In the past couple of years, this has been more or less a statement of accounts kind of moment. I mean, it's a big deal for newspapers and television channels, but aside from that, the budget was slowly losing its relevance through the course of what happened in the year. Is it different this time round?
I think it is. So there is a lot of forecast uncertainty. There is been quite a bit of volatility in where we are really as an economy in terms of our fiscal balances. So we have seen, for example, uncertainty on what should be the nominal GDP growth in FY22. Right. So yesterday the IMF published 11.5% real. Consensus is at about 9 to 10%. I think that the real itself can be 13 to 14 and nominal can be 17 to 18. So what the government chooses is much more important than it would have been in the prior years. Secondly, the granularity at which the fiscal deficit itself is measured. So, for example, there could be a debate in prior years on 10, 20 basis points. This time, I think the least count itself is 0.5% point. But it'll be 5%, it'll be 5.5% deficit. And what is the medium-term consolidation path? Because the 60% debt to GDP now, I think, is not achievable in the next 10 years. So what is the path that the government shows for the next 5 years in terms of debt to GDP and potentially the fiscal deficit targets? There is also expectation, I think, on reform, on how the disinvestment process can be kicked off. There is a lot of expectation on what happens to the financial sector, because there seems to be some disenchantment within the government that every few years these PSU banks come and ask for a lot of capital. So how do we solve this problem permanently and also address some of the issues with lack of financial system capacity? So I think there will be quite a bit to mull over in this budget.
Vetri, there seems to be some pre-event nerves as well. I mean, yes, today itself, we've seen almost 1,000-point slide on the index. Are people going into the event light, or is there some stress around what the event might throw up?
I'm not sure, Mitali, that I would, interpret any of this pullback as necessarily being related to nervousness about the budget. I mean, this has been a completely frenetic rally ever since the end of September. And if you choose to go all the way back to the end of last March, then, it's been a phenomenal rally. So there's nothing about this pullback which sort of makes it look different. I think, as always, and unfortunately, I say this as an equity investor where we are supposed to think, particularly long term, is that the mood swings of the market in and around the budget are literally limited to the impact that it has on the pocketbook and the wallet of investors, which means nothing impacts them more than changes in things like tax on dividend, change in capital gains tax, change in STT. Before we started the session, you talked about wealth tax. So those are the things, unfortunately, that sort of drives the short-term reaction of the market. May not matter in the longer scheme of things. And as people say, equity is an asset which is really long-term, right? Because it's almost like an eternal asset. Companies continue for a very long period of time. But unfortunately, the short-term swings are just about these changes in taxation related to ownership of these equity shares.
Shiva, while the interest and the limelight is often taken by what happens with the equity markets, the brand is borne by the fixed income market. There is some exhaustion because of the size of the government's borrowing calendar. Is the fixed income market a bit wary about what will be announced for the coming financial year, or has it more or less primed itself for the figure?
Yeah, Mitali, I think this is going to be very interesting because you're absolutely right. And the one thing that matters for us is what is the size of the borrowing program or the size of the fiscal balance itself. And the markets kind of accepted that we are not, and also as what Neelkanth said, that far away from FRBM targets. So let's assume that we're probably going to be about 5.5% of GDP fiscal deficit next year. That's kind of priced in. But it's important to see whether you're going to be at 5.5. It's kind of priced in. We are just about 6% on the 10-year. We were at 6%, give or take, on the 10-year Indian GSEC last March. So in that sense, market's gone nowhere. The question is, can they really bring it much lower, or if they go for a very big bang growth budget, can it be significantly higher than that? I think that will really set the tone for the coming year. The closest that we have in terms of a historical precedent for this was back in 2009. It's just coming off the 2008-2009 financial crisis. The government actually went for a very large expansionary budget, cutting excise duties and going for a big expansion. And that kind of set the tone for the next 2 to 3 years when the pressures on the economy really went up. Obviously, growth came back roaring, but then also you had a buildup of inflationary pressures, and RBI then had to do a lot of lifting. So I think it's going to be very important. This budget is going to be very important in setting the tone for the next 2 to 3 years what the direction of macro policy overall.
As an economist, which figure is it that you're going to be watching most carefully? Do you want to know what she has to say about the fiscal deficit figure, her nominal GDP targets, or is it more important what she does both on the expenditure side and how she's targeting revenue for the year and for the year ahead?
Well, this is a tough question, but if I have to look at only one figure, I would probably look at expenditure as a proportion of GDP. And the reason I'm saying this is because, the last few months have been amazing for India. It's seen a very strong recovery. But to ensure that the recovery is sustained and it's actually built on, I think some big shifts need to happen through 2021. For instance, we need to move from goods demand to services demand and a couple of other shifts. And if I think of each of these shifts, it seems very clear to me that government spending will have to play a big role for it to happen. In fact, I believe that in 2020, RBI was the main game in town. It did most of the easing, most of the help for the recovery. But in 2021, the RBI may have to take a back seat, and the government might be the main sort of game in town. I sort of think about 4 shifts. Number one, moving from goods demand to services demand. Because in goods demand, we've already reached pre-pandemic levels. It's services, where a lot of catch-up potential is there. But that will only be possible if the government, works on a very, very quick and efficient vaccination rollout plan. Another big shift is moving from rural India to urban India. But here too, there will be a lot of distress, in the process. A lot of people who've lost their jobs in urban India will need social welfare spending for longer. Same goes with a shift from concentration of wealth at the top of the pyramid to more better distribution of wealth, to the bottom of the pyramid, which is also necessary for sustained growth. Again, the government will have to play a main role. And then if you think about moving from consumption to investment at a time private sector may not be very keen, again, the government will have to play a big role. So I think government spending on all of these, a vaccination rollout, continued social welfare spending, and also capex is going to be very, very critical to ensure that the rebound in the system continues, and that's probably one of the main figures I'll be looking at. Of course, I'll be looking at the fiscal deficit too, but I think expenditure will get most of my focus.
I want to spend some more time on expenditure, but before that, Neelkanth, I'd like to come to you about this fiscal deficit issue. It's a bit of a must game now. What do you think would make the market happier? The fact that she goes out and says, here's what it is, it's at 7.5%, here's what I'm targeting for. Or do you think the market would be more influenced by some transparency in the numbers, where the finance minister says, look, we've got a problem, it has been expanding, we've decided to cut ties with the FRBM, we're setting out a new glide path for us. Would you be so ambitious as to expect something like that from her?
See, on the medium-term glide path, I think it is essential. See, what markets hate is uncertainty. So the fact that we currently don't know when the government or the bond market does not know when the government can get back to say 70% of debt to GDP, state plus center, is I think a very big uncertainty for the government for the market. And I think setting an anchor to that will be should be an expectation. It is not, I think, too much of an ask, and I think the government would be fully aware of that. Remember that this is also a year where the Finance Commission report will be tabled in the Parliament, and that will also, in many ways, set some anchors for what the government must do in terms of healthcare, in terms of defense. I think, going by newspaper reports, doesn't look like there will be a very big shift in the percentage of money sent to states, but I think on specific issues related to healthcare, defense, education, there could be guidelines given. So I think the fiscal deficit, and if you're right that there's been a lot of off budget stuff that has been happening, and there will be, I think, continuing uncertainties on that. But in many ways, if you see, the challenge for the government is going to be how much to spend, and therefore I am of the view that the government may actually surprise positively on the fiscal side, even if it gives a target which whatever gets published on 1st of Feb. As the year progresses, we may find that the government's fiscal deficit is actually a lot lower. Just me to explain that. See, almost 80% of government spending is what I would call committed spending, in the sense that it is interest, salaries, pensions, defense, GST compensation, grants to states, PM Kisan, Narega. So these are committed spends. If you remove those, and assuming that you get, say, a 13 to 14% tax growth, right? That's what the government perhaps will go with, and a 5.5% fiscal deficit. Your total expenditure can grow at 16, 17%, and the residual, that 20% that remains, which is not committed already, will have to grow at 150% year on year, and maybe 60, 70% higher than FY20 levels. Can the government really spend that much? We tend to assume that if you find that space on an Excel sheet, that spending will automatically happen. It's not that easy. It is easy to cut tax rates. It is easy to transfer money into people's bank accounts, which is why June quarter spending was so strong. Year on year, GFC was up 20%. But when you get down to actual execution by the government, it becomes very challenging, which is why September quarter, the government spending was down 20% year on year. So when we look at the fiscal deficit, we have to also look at, as Pranjul was saying, that what is it in the context of the expenditure, and how much is the increase in discretionary expenditure that the government is committing to.
Did we come in on that, on both these points of fiscal deficit and expenditure? Because the finance minister has, in a previous interview, indicated that she's not too worried about the fiscal, but equally, beyond the point, you cannot spend your way out of a pandemic the way you can out of a recession. What does the market want to see in the minutiae of expenditure side? Details from the finance minister, and do you think they are overly worried about the fiscal deficit figure?
So I think sorry, this was the question for Vetri. Vetri, go ahead, please.
No, so to my mind, and I don't say this because I'm from the equity side of things, but I think we're asking for too much if we expect the finance minister to give you a target with 2 decimal point precision on where we will end up in 21. I honestly think it would be far more realistic for the FM to say, look, we've just been lucky. We've not seen a second wave of COVID. We haven't seen a rising graph one way like the US, but we don't know what could happen in the next 6 to 9 months. Of course, we've got visibility of the vaccine. So maybe you need to have a 200 basis point corridor that if all goes well, I'll get my fiscal deficit down. But if something goes wrong, then I might actually go to the upper end of that boundary. So I actually think it's far more useful to think about the tactics within that range rather than try to go for a single number. The second point, and I think Neelkanth hit the nail on the head over there. You know, for many years, we've seen these grandiose plans and designs of spending. The reality is that government is not very good in spending at scale with speed. So I honestly think the tactic that worked best in 2009, which is putting money into everybody's pocket or literally making sure they have more left in their pocket because you bring indirect taxes down, is actually a far swifter way of moving money into people's hands and letting them do what they think is most appropriate. We don't have to be patriarchal or ideological about this. Just put it in people's hands and they'll do what is the best benefit to them. The only other element that I would add is that perhaps an element of direct transfers is certainly necessary this time around, because tell me one thing, Mitali, without doubt this is a unequal recovery. If you don't use fiscal means now to address the inequality of the recovery, when will you do so? So this is the point in time to actually do that. And if that means putting money into people's bank accounts by way of DBT, then please do that. I think we know that there are segments who've not enjoyed this recovery. So I think it's the speed and scale at which you can get money into people's bank accounts that will determine the course of this recovery, along with that great unknown, which is the virus itself.
No, I agree with you completely, Vetri. And if not now, then when? Because the argument for not having done it when we were in the heat of the pandemic was that we were saving this kind of spending up for later when it would matter more. Pranjul, come in on this. What do you want to see from her in terms of pure fiscal spending, and what kind of follow-through impact do you think that might have for the economy?
Yeah, look, if you're asking me in terms of numbers, I'm hoping that expenditure as a percent of GDP remains unchanged at elevated levels. So, which was 15.4% of GDP by my estimate in FY21. I'm hoping it remains the same in FY22. That's one. But within this, I'm hoping there is a change in quality. I'm hoping that the capex budget is a bit more. Probably about 0.5% of GDP more. Now, somebody can turn around and ask me that can in one particular year, suddenly the government start doing so much of capex? What about all the implementation bottlenecks on the ground? And my answer there is that, look, India tends to do some amount of replacement capex every year, relaying of roads, mending of bridges. A lot of it did not happen in 2020. And in some sense, 2021 may be doing 2 years of replacement capex. And therefore, there may be absorptive capacity for slightly higher capex on the ground, for FY22, basically the calendar year FY21, 2021. This, I think, will also have another sort of positive impact, which is urban welfare. Now, we know that for rural welfare, we have Narega, we have PM Kisan, and so on and so forth. But for urban India, we've actually struggled to get a good social welfare scheme together, and you really can't get it done overnight. So probably your best bet right now is to do some capex on the back of which there is some jobs in the economy. Even if they're for a year or so, it'll be a good sort of bridge until things normalize for good. So I think capex, slightly higher capex budget at this point will be very useful, alongside continued spend on Narega and PM Kisan, which largely takes care of the rural distress. Having said that, this is all short term. This is for this year. I think the budget should also have a view over the medium term. And I say that because, we've not yet seen the worst of the pandemic in the growth numbers, in my view. I think right now we've been lucky, as Vetri also mentioned, that we've not yet had a second wave. And there's a lot of pent up demand and a wall of savings sort of supporting that demand. But once that goes away, then we may start seeing the real scars the pandemic has left behind. And one of that could be banking sector stress. Even when I look at previous slowdowns, I find that NPLs at banks actually doesn't rise in the year of the slowdown, because in that particular year, there are a lot of emergency steps that can be taken. Regulatory easing, or companies not paying off vendors or cutting salaries and so on. But these emergency steps can't be taken every single year. And at some point, the distress and the stress in the system starts showing up. So some sort of a planning that how do you deal with the scars in the medium term in terms of bank recapitalization bonds, or bigger reforms, lessening the mandate that the government has on public sector banks, but whatever it be. But there has to be an eye on the medium term. This budget can't just focus on this year alone.
Vetri, by the way, you're being very charitable about the fiscal deficit target being missed by a couple of decimal points. I think it's been more than that. And the other one I would watch is, frankly, the taxation figure, which has been a miss for the last 2 years running. But Shiva, I want to turn to you for a bit in terms of what's been happening on the fixed income side. 2020 was sort of a world of dichotomies between equity and fixed income, where you saw very, very sharp outflows. What is it that the bond market is suffering from at this point, and why is it underperforming its Asian peers by such a big margin in terms of flows?
Right. So I think this is an interesting question. I think there is obviously the Indian bond market has taken a lot of support from the RBI over the course of the last year, but the problem for the RBI in some sense is a lot of the RBI's intervention happens only at the very short end of the yield curve. So you have seen a collapse in money market rates, you have seen a collapse in short-term bond rates, but actually nothing much else. And when we had the start of the lockdown, the impact which was felt in equity markets, we had a sharp correction in equity. It was also seen, for example, in credit markets, where you had a sharp expansion in credit spreads. Now, while those credit spreads have started to narrow, they still have not reached the pre-COVID levels. Or, in fact, I would say you need to go back to sort of even a pre-ILFS, which is now a 3-year-old story. But to really say that we have come out of the woods in terms of well-functioning credit market. So there's a long way to go, I think, in terms of repairing certain segments of the bond market. But also, it's very important, so the absorptive capacity of the bond market for such a large supply of bonds. So how do you fix that? Right. So how do you, if you have, let's say, another 10, 11 lakh crores of issuance next year, how does the market absorb that, especially if the RBI starts normalizing interest rates, especially if the RBI comes out of this extraordinary easy liquidity program and starts absorbing liquidity, then how does the market really absorb it? I think that's going to be very interesting. Obviously, in the recent past, we have kind of shelved this idea of getting India into global bond indices. So do we get that back? Do we open our markets for foreign investors? That will drive us, I think, a lot of flows, a lot of long-term flows into India. We worry about foreign investors being very tactical, but that's because we're not index members. The moment we become part of indices, we tend to get more ETF type of more stable flows. I think that's going to be something which we need from a bond market perspective. But I think the point I want to make also is that the discussion that has happened so far if you can boil that down into two aspects. One is, how does the budget support consumption, and how does it support infra? I think that comes ahead of all of these bond market needs. In bond markets, you can say that the bond markets are funding the government, but that with the support of RBI, that can go on for another year or so. But fundamentally, the budget need, from a budget perspective, whatever we say, ignore us for another year and do the right thing from the economy perspective. That's what matters.
We will need to come debt to GDP, though, right, Shiva, before we look at global bond indices. But I wanted to talk to you about this other idea that has been bubbling around of launching COVID bonds, specifically with an eye to infrastructure. Is that something the fixed income has its eye out on? It will not solve the entire problem, but do you think it could be an interesting concept to bring into fixed income?
Yeah, I mean, I think these are just left pocket, right pocket issues. I mean, when you talk about the government, if it is part of sovereign debt, it doesn't matter whether it is a COVID bond or a government bond or a public sector, what's called a government service bond. I mean, there are so many varieties of these bonds. All that matters when you change the nomenclature is that the yield changes a little bit. So, it's better that from the government's financial perspective that they just borrow it on balance sheet, they get the lowest interest rates that way, and then they spend it also on balance sheet. That's probably the right thing to do. The limited point I'm trying to make here is that in searching for certain hard metrics like fiscal deficits and debt to GDP, we try to there is this thing that the moment you say that is the measure, then we try to shoehorn that measure by trying to exclude, say, for example, some debt from being considered as part of the fisc. But the reality is, it is fiscal debt. I mean, it is government liability in one form or another. So it makes sense for us to have a comprehensive economic plan which, for example, consolidates public sector debt to the extent that it is government guaranteed, for example, and then take a more comprehensive view of the fiscal position than to target a specific number. I mean, Vetri mentioned 200 basis points range on the deficit. I mean, that's 5% to 7 percentage points of GDP. It's a huge number, but that's where we have been. I mean, we thought we would be somewhere in the 4% mark, and we're going to be ending up at 7% this year. So, you need to have those release walls which allow for a large variance if there's a shock to the system, and not worry so much about that last basis point of trying to hit a certain target percentage of GDP.
Yeah, no, spot on. Just want to finish that point up with you, because we were speaking earlier about how the RBI policy meeting, the first one this year, is scheduled later this week. How soon and how sharply do you think the Reserve Bank is going to pivot in terms of its liquidity stance?
Right. So, as I mentioned at the start, that I think there's going to be a changing of guard amongst policymakers. If RBI was the main game in town in 2020, I think the government is going to play that role in 2021. And the reason I think RBI will begin to take a slightly, a smaller role is because of inflation. Now, in 2020, we saw inflation higher than 6%, which is the upper tolerance level, and it was on the back of food prices. Thankfully, food prices have come off, and I'm hoping they're not going to be a big problem in 2021. But we have a new problem emerging in 2021. I'm a bit worried about what I call services inflation. If 2021 is going to be the year of pent-up services demand, in the same way the previous year was the year of pent-up goods demand, then we may actually see some services inflation come up. We have this concept of menu costs in service providers, in which every year service providers increase prices by a little bit. They didn't do it in 2020. In 2021, when a huge wave of demand comes, then there could be 2 years of price adjustment all done in 1 year, and that could be inflationary. And the reason I worry about services inflation is because, as opposed to goods, which can be traded. So, for instance, if something is expensive, I just import more of it from somewhere it's cheaper. Services are non-tradable by definition. So once it takes on, it can be a problem. Now, I'm sort of saying all this, but I'm not really trying to sound, very scary. Overall, I think we have a lot of things going for ourselves. I do think food inflation will be low for most of the year. But unfortunately, core inflation services will be high. If you put it all together, I see CPI inflation in the 5 to 5.5% range for FY22, which is higher than the RBI's 4% target, but lower than the upper tolerance level of 6%. So what will the RBI do here? My sense is that RBI will try to break down growth into cyclical recovery and potential growth. As long as cyclical recovery continues to happen, I think the RBI will try to normalize by sucking out some of the excess liquidity that it has sort of had in the market for a long time. One aim of doing that would be to raise the overnight rates up to 4%. Right now they are about 3.5%. The aim would be to raise it up to 4%, which is up to the repo rate, and that will ensure that India's real rates go up to zero. Right now, they are immensely negative, and we know in the past that negative real rates can be inflationary. So that could be one of RBI sort of mechanism this year to suck out, excess liquidity in the market and nudge overnight rates up to 4%. But then comes my second part, which is on potential growth. I worry that potential growth would have fallen through the pandemic. My own sense is that before the pandemic, India's potential growth was 6%. It has fallen to 5% after. And I feel that the RBI will not raise the benchmark repo rate until the potential growth starts to rise again. So, to cut a long story short, in view of elevated inflation, RBI will suck out the excess liquidity from the market. But at the same time, it won't raise the repo rate, which a lot of the market looks at. It won't raise the benchmark repo rate just yet.
Sure. Vetri, for as long as we've been speaking, the one question that always comes up for every budget is the disinvestment target and the disinvestment ambition. Again, this one has been a miss. Perhaps 2020 was one of their worst years in terms of hitting the market and raising proceeds. How are you feeling about this year? There are very big names out there: Air India, BPCL, potentially LIC. Do you think it's going to happen?
Well, I don't know. And I suspect neither does the FM or neither do the bankers working on that. This is a difficult environment in which to pull off these transactions. I think actually the harsh reality when we use the word disinvestment is that we've run out of things to disinvest, right? Because you've brought the stake down to 51% in pretty much most of the large companies where you could. So really the only way forward now is to privatize. And I think over there, I'm glad to see, be it BPCL, be it, Air India, clearly the government is now willing to privatize, which not only means you bring in the revenue, but you also don't have to provide future capital going ahead. So, to my mind, divestment as a story is now behind us. The government has already bitten the bullet, thankfully so, on privatization. We just need to see the execution, take place there more aggressively. I don't think disinvestment is a story anymore in India. Everything that could have been brought down to 51%, it's already been done. I think there's only one other small story, which is, of course, the fact that there are many global investors looking for yield and annuity assets. I think the government is experimenting, the private sector is also experimenting. That can you take completed assets, convert them into yield assets for foreign investors, release the capital that's blocked in those assets, and use that to drive another wave of capex. So they are talking about this in sectors like power distribution and highways, but that could be a interesting sort of solution to two problems. One, absorb a lot of this foreign capital that wants to come in, and secondly, remember that PPP as a model for infrastructure is now broken. Nobody even talks about it anymore. So the sovereign will have to take on the role of the risk during project execution, the land, the environment, the financing risk, get it to the stage where it's an operating asset, and that will be, I think, the best contribution the sovereign can make to capex and driving infrastructure investment.
Neelkanth, same question to you. What do you reasonably expect on privatization stroke disinvestment?
See, I think more than just the annual target, right? So the annual target, as we know, despite all the political commitment that the government has, so the government, could have privatized BPCL, for example, in 2016 itself, which has still not happened. So the political commitment is there. There is clearly some bottleneck in the process, which has prevented these things from happening. So it would be more interesting to see a change in process, a change in approach, and also perhaps a medium-term target where the government lays out that these are not things that you kind of put it out in the budget and then 6 months no one follows up, and then toward the end of the year there's a rush, or even the trickle feed disinvestment, as Vetri was saying. The fact is that the one of the reasons PSU stock share of market cap has collapsed is also that the government keeps doing a trickle feed of stock supply. So more strategic approach, more of a medium term approach, more of a change in how the government approaches this investment is something that would be perhaps a lot more supportive to the market. Now, coming to an associated question, and I think we need to think about it as well as we discuss the range of issues that we have already discussed, is what is it that the bond market, or what is it that the markets really look at? I think eventually what matters is debt sustainability. And achieving debt sustainability by just cutting expenditure or looking at the numerator, which is the debt level, is, I think, unwise. It is equally important that we look at the denominator as well. I mean, how do we get growth back? See, the very fact that 85-90% of government spending is non-discretionary at the union government level suggests that the government cannot really cut expenditure. Right? Can you cut interest? Can you cut salaries? Can you cut defense spending? Can you cut Narega, which is actually a social safety net? You cannot. And therefore, you need to grow out of this problem. Just cutting spending is not the issue. So I think steps that revive growth, and if the funds for reviving growth, say for building infrastructure, if the government just reshapes its balance sheet, what is the need? See, maybe when 50 years back, when the economy was still a low per capita GDP, poor economy, there was no way you could form capital to, say, set up a steel authority or an NMDC or a Hindustan Copper. And now there is no need for the government to be in these sectors because the capital formation has happened. So I think they can exit. But now you need, as we've discussed earlier in this call, an urban safety net, right? So if there is someone in the cities who's lost a job, how do they feed themselves? If you have a problem with the healthcare infrastructure, I mean, why is it that the government share of healthcare in terms of personnel is only 15-20%, and in the first wave of the pandemic, the private sector was just shut down. So we actually lost healthcare capacity when we needed it most. How do we address some of those problems? And I think those are incredibly important questions that, if the budget can answer, will be very helpful, because that will then show the path for growth sustainability. And I must say that I disagree slightly with Pranjul on the medium-term growth. I think that some of the steps that have been taken, like say the PLI schemes, some of the monetary easing that we have seen, the revival that we are seeing in urban real estate markets, I think the medium-term growth trajectory is also already looking up.
Let me ask you this, Neelkanth, on your point about the distress that has happened at a certain level, it seems like we've settled on an alphabet now in terms of what the recovery looks like, and it's K-shaped. Is it a possibility that the stock market continues to rally if indeed we are set up for a K-shaped economic recovery, and that happens without the basis of a very broad economic recovery below? Because even in the corporate numbers, the numbers are good because of cost cutting, just to take the point you were making about the government itself. Can that be a possibility that the broader economy continues to struggle, but at the top you have, the financial market, which actually does pretty well?
I just recently read a piece by another commentator at the global level. So apparently when Kennedy was asked about the Great Depression, so Kennedy, as you know, came from a very rich family, JFK, that is. So he was asked, what do you think about the Great Depression? He said, I never knew about the Great Depression till I went to Harvard and I read about it. My only experience was that when my father hired some gardeners, when we didn't need any gardeners, just because he wanted to keep them alive. So it can be totally disconnected. See, the reality is that if the formalization process accelerates, which I think it has done, and the bottom 50% consumes more or less the same as the top 10% of the economy. And the bottom 50% of the economy, there is very little discretionary spending, right? So they eat, they buy those 2 clothes a year, they spend basic stuff on telecom, repair their houses when it's broken, and basic education. But so what can they cut? So inequality is a social and a political problem, right? And at least for in the near term, of course, social and political problems will cause economic stresses and policy shifts, but in the near term, they actually do not impact reported earnings. And the market in India in particular, where the market and the economy are totally disconnected, or to a large extent disconnected, I think this inequality can keep worsening and the market can keep going up. So that can happen very much.
That's a sobering thought indeed. Shiva, I want to talk to you about the banking space. I mean, not clearly your mandate, I know, but there's so much expectation on what happens for the banking system, whether it is a fresh round of liquidity, whether it is setting up a DFI, a bad bank. Much of this has been considered. Are you expecting to see something along those lines?
There is obviously some kind of discussion on this, which keeps coming every year or every other year, that we'll come up with some new way to absorb non-performing loans of the banking system, etc. I'm not really sure if it is really necessary. So I do believe that this is on the one hand, you do need banking capital, to be sure, right? But growth capital is available at plenty, right? So we just need a way to handle perhaps some of these public sector banks, a way to wind down their balance sheet. In a sense, the Indian banking system is getting privatized, but not by sale of assets, but rather by the share of the private sector essentially growing much faster, and therefore eventually the public sector is becoming much less relevant percentage of the total banking system. So if that continues, then I think this will no longer be a problem. The core comes down to the fact that growing banks get access to as much capital as they want. So fundamentally, I think the banking system's role is to really support growth, and I think that is not going to be a challenge. So I don't think we need a national bad bank. But having said that, is it one of those things that can happen? It could happen. We don't need it, but we could still see it. So so but we still need some of these regulatory forbearance. I think a passing mention was made, about how regulatorily we have sort of eased the rules so as not to report high NPLs in a crisis year. So it's possible that we may yet recognize some of these stresses of the current pandemic maybe in the next couple of years. We saw that in previous cycles also. So it's possible that the RBI may want to sort of calibrate that exit from the current forbearance in a way that future year profits are sufficient to take care of so we say staggered losses from the past year. So I think there are ways that we can get around this problem of marking non-performing loans over a period of time. Let me also take this opportunity to go back to the last question you asked about the K-shaped or the two-track kind of system and the formalization, etc. This is super critical, especially from a financial markets perspective, whether you look at debt or equity markets. When you look at the kind of capital market instruments, right, whether that's equity or whether that is bonds, really speaking, we're talking about the top few hundred companies in India. They are the ones who access equity markets. They are the ones who access bond markets. So the fact that you have a sort of twin track with high formalization, the large companies taking share, partially explains why profitability in those entities, whether they are credit issuers or whether they're equity listed companies, have outperformed the macro. So in a sense, the disconnect between equity market performance or bond market performance and macro can be explained by the fact that macro is not important. What matters is the performance of the companies in the sectors and the segments that you're looking at. And those companies have done really well. So the question really is how do we get the other part of the economy, so the remaining 50% of the economy to also do well? You can't lift up the economy by let's say increasing the taxes on the top and the redistribution, because both they will. I don't think that will net increase necessarily so got to find out some ways of actually enabling the rest of the economy to grow as fast as the largest companies are doing. And that will also solve, as Neelkanth was mentioning, the problem of debt sustainability. I mean, you need the denominator to grow faster. I think the denominator can grow faster, but they need to find some ways of sort of leaving more money in the hands of a lot of people, whether that is through transfers, lower taxes, etc. That's the choice for the government to make.
Pranjul, it's a bad bank issue. It seems like the government itself is not keen on pumping in direct, capital to this. Perhaps they'll set up an SPV again with, the DFI. One part of the community says, look, that's not what we need. We need better clearances, while the other side says infrastructure needs a DFI. What do you expect to see in terms of, reworking the financial architecture or supporting the financial architecture?
I do think that the government is looking at this budget as a blank slate. We've been hit by a pandemic. It's a blank slate. We have to rebuild this economy from here. How do we do it? And whenever you're thinking like that, you want to sort of, set up some new institutions. And that's why, the conversation on bad bank, DFIs and all are, coming back at this point. My sense is even if something is announced in the budget, at this point, it will be mostly exploratory, setting up a committee which thinks about if we do get a DFI, what role could that play? Because, a lot of people believe that, it's not useful anymore. It was useful at a time when India's financial markets were not deep. On the other hand, some other people think that it is useful because there's a lot of new things it can do, and some other countries like China have showed us that. So, I think at this point, it will be just sort of like a committee set up. I don't sort of see something rolling off the ground immediately. So, this budget could be a place where some of these ideas are sort of sprout, but I'm not sure if all of them will then become successful over time. We'll have to see how it all unfolds. But actually wanted to take this opportunity to comment on this formalization point which Neelkanth and Siva had made. The fact that this whole formalization that we've seen in the system in the last year is here to stay, and it's going to add to growth over the medium term. I just wanted to sound a word of caution there, because if we also look at what had happened during demonetization, in the demonetization months, there was a huge amount of formalization we saw, and we actually saw corporate results increasing, and we saw equity markets were on fire. But 1 year down the line, some of this formalization, or in fact all of it at that point, did not stick, and then things were back to normal. Now, I do think this time is different from demonetization. I do think because, the pandemic has lasted for so much longer, there has been some huge shifts of demand. So, some of the formalization could stick, but I'm not sure if all of it will stick, because the ecosystem that was supporting informality in the last couple of years hasn't really changed. So at some point, informal firms could come back, and then you could see the impact on corporate results of listed firms, and then things may not look that exciting. I think one way to think about it is that, look, there has been forced formalization in the system. There has been an iron hand of the pandemic that has led to formalization. But now, how can we actually make it more organic? How can we actually support the informal sector and push them towards formality? And one way of doing that is actually ease the regulatory environment in which informal sectors function. So they are forced or naturally pushed towards formality rather than forced to die. I think, if this support comes in the budget, some sort of longer term thinking on how do informal firms over time become formal in a very organic way rather than in a forced way, I think that sort of formality will stick for longer. And I think this is something the equity markets should sort of think about carefully, that all of the formalization we've seen in 2020, what part of it is going to stick and what part of it is just going to fade away.
I'm not sure what the equity market is thinking right now, Pranjul, but it's just been such a hell of a ride that I think they haven't been thinking much lately. Vetri, just to get down to the nitty gritty of it, this is also the golden goose that is laying the golden eggs, the stock market. You mentioned and touched upon taxes right at the start of this conversation. So let me just, quickly circle that one. Do you expect to see any changes in that regard? STT, some tweaks on LTCG. Could there be a wealth tax, as the chatter is about on taxation? Do you expect to see anything?
Well, I certainly hope not. I don't think there is a reason at this point of time to really tinker with any of the architecture. I know most people talk about doing away with long-term capital gains on equity, reducing STT. I mean, I think these are still questions about the right architecture and they can continue. I don't see a pressing need for these to be addressed in the current budget. So I'm not really looking at this, doing anything significant. I would just go back to 2-3 things which, from my point of view, are really the tactics that government needs to bring to measure in this budget. When you look at the early part of the pandemic, the government saw GST revenues not coming in. They did a smart thing when fuel prices collapsed to actually sub-zero by taking up the indirect taxes on fuel quite dramatically. Honestly, I don't think there is a strong reason for that to continue, given that you've now got GST revenues coming back in and the economy is having to deal with lifetime highs in fuel prices. So if there's one easy way of putting it back in people's pockets, I think that's an easy way to go. I think the other thing that the government could, which they're already doing, right? Because look at it this way. You've already given corporate India a 15% tax rate on new investments. There's a 25% tax rate that they're now getting the benefit of. You're spending 2 lakh crores, which is nothing but a subsidy for setting up manufacturing in India through the guise of PLI, which is a very well-designed scheme, but it's a huge manufacturing subsidy. And then you've got record low interest rates. I mean, I cannot imagine any environment in which an entrepreneur is not going to feel positive, particularly when they're seeing that they are coming out of this, crisis, so to speak, stronger with profitability. So I'm quite optimistic that for the first time in many years, corporate India, looking at all of this, the cost of capital, the taxes, the subsidy for PLI, and all these other factors, is actually going to be quite excited about, putting capex in the ground. If there's one place the government can add some measures, I believe it's actually in real estate. Remember, real estate has been in a downturn almost for about 5 or maybe 6 years now. It's a significant part of capital formation in India. The biggest chunk of household capex goes into real estate. With these record low interest rates, if you actually provide a break to individuals on housing, I don't see any reason why that can be a significant driver of the capex cycle. And I genuinely believe the actions of those home buyers with the entrepreneurs who develop properties. And given that there's been a dramatic shakeout of the supply side, thanks to RERA and all the other changes, you can actually get a high quality real estate cycle going, and you may be able to get that going as a capex wave much faster than anything else. So, these are the sort of critical things that I would look for in the budget. And as I said, don't tinker with the capital market taxes. I don't think this is the time for that.
Yeah, no, that's a good point. But one waits on for that elusive capex cycle, Vetri. It seemed like it would come with the last time the corporate taxes were cut, but no such luck. Neelkanth, how do you play this tactically? I mean, from the stock market point of view, here we have a market that is bubbling around all-time highs, that is extremely expensive, where you have seen very, very solid rallies in spaces like IT, a couple of heavyweights, and it's got this big wave of liquidity that's pushing it. Tactically, how do you approach the market over the next couple of months?
So on tactical things, my I think sort of value add is generally quite low. If I was thinking more 6 to 12 months, I would remain constructive. I know the market is extraordinarily expensive. It is the Nifty price to earnings is 3 standard deviations above its 10-year average, and it is from these levels it is very hard to see unless you expect earnings upgrades, and given that in the past we've only seen earnings downgrades, it seems unlikely that earnings will be upgraded. But I think that with or without the budget, the FY22 numbers need to be bumped up. So if you look at what IMF did yesterday, so their earlier forecast, they were projecting FY22 to be about 2.5% below FY20, right? Now they are projecting it 2.5% above FY20. I think that FY22, when the dust settles, meaning that FY22 is an actual, will be at least 5 to 6% ahead of FY20. So there is still a meaningful upgrade possible. And you will see that in company earnings, because generally GDP growth and company earnings don't have much of a correlation. But nominal GDP growth is more or less the starting point for a bank's analyst or for an autos analyst or for any analyst. And as those numbers get bumped up, you will see that the earnings themselves are starting to move up. I also think that as clarity emerges on some of these PLI schemes, so right now these are just schemes that the government has announced, right? We are now going to see in the next 2-3 months the details of, say, the auto PLI, the textile PLI, the food processing PLI. And just like if you saw when the handset PLI was to start, the clock starts 1st April, right? And these companies used air shipment to get equipment, old equipment back to India or to India so that they could meet that, that FY22 target, because that's where the revenue clock starts. If the other PLIs are starting FY23 and the details are announced, say, in April, I think people will be in a rush to add capacity. Remember that the PLI schemes require that this be from a new plant. So if you have won you're one of the winners of the auto PLI, for example, you'll be in a hurry to start this plant. So I do think that capital investment will start. And I totally agree with Vetri that, when we think about government intervention, it feels very tempting in a PowerPoint presentation or an Excel sheet, where you say, okay, so these are rich people, let's take their money and give it to the poor. Does the plumbing exist? Will you be able to get that wealth? If you say put a wealth tax, do we have the capability of administering wealth tax which will generate 10, 20, 50,000 crores? And do we have an economically sensible model for transferring that to the poor? If we don't, then I think we should just work with the normal economic forces. As Vetri was saying, if we just create the enabling factors for capex to happen, jobs will be created, the poor will get pricing power, wages will start going up. Right now, with Narega demand being 80% higher year on year, I don't see any services inflation or any of the wage inflation things happening. We need much stronger growth for that to happen. This is not to say that the government has no role in social safety and security. I think those things have to be created in parallel. But as of now, as growth is a priority, see, even if we are 6% above FY20 and FY22, we are still 7% below where we would have been, right? So it's important for us to catch up on that growth. And for that, I think just creating an enabling environment and not disrupting with things which in reality don't yield that much tax. See, as we were discussing, if your fiscal deficit goes from 5.2 to 5.6, you get 80,000 crores, right? Or maybe 90,000 crores in this year. And if you apply some surcharge, it'll give you, maybe 10,000 or 20,000 crores and create a lot of goodwill and a lot of angry people and upset people. I think it's much better if the market expects you to do 5.6, go with that. Don't try to get a too low a fiscal deficit. Just try to prioritize growth right now.
Yes, there has been talk of a COVID cess and a defense cess, so lots of chatter around that front. Shiva, specific figures from you. What kind of lending figure do you think would make your market jittery? And what would you set as a reasonable range for the benchmark bond this year? What are people working with?
Yeah, I think a 5.5% thereabouts on the fiscal deficit implies a borrowing program in the range of 10 to 11 lakh crores. On a gross basis, net will be about 8 or 9 lakh crores. That is, I think, what is kind of priced into the market right now. I think the market expects that kind of a borrowing program to go through with some limited support of the RBI. I think that makes a lot of sense. I think if it is substantially above that, and again we're talking about fairly large swings, maybe if it is materially higher, starting to push towards the upper half of upper half towards the 6% mark, then I think we are looking at a significant up move in bond yields. I think the bond market today is kind of sort of agreeable to a reasonably large borrowing program, but it's still going to be difficult. On the other side, I think it will require, if you get a big positive surprise and you're looking at, let's say, a 5% or below number on the fiscal deficit, I think we can see a small move down. So it's kind of an asymmetric kind of a move. If you get a very contractionary in some sense fisc, then I think we may see a small rally. But I think the right thing to do is to go for growth, and the market is anyway willing to accept it right now, and we may not see a blowout in yields this year.
Completely out of time. Vetri, final word with you. Humor me with a market range for the rest of this year and what it is that you expect to see, beyond the budget, because that's what life has always been. It's the budget and then life carries on as it must.
I hate to disappoint you, Mitali, but I'm a lousy forecaster. That's 25 years of experience, and therefore I try not to address any part of my mind space towards forecasting what it'll do. But I just want to add to one point that I think Neelkanth made. It's true the valuations have gone up, and therefore from a valuation and asset allocation point of view, we'd have to be cautious about equity. But I'd also like to make the point that my own experience in the last 25 years, whenever we have seen a strong upcycle in the economy, more often than not, you actually see the market getting expensive very early in the cycle, right? Because the market is your lead indicator. So I'm not saying it doesn't give you a head fake every now and then, but therefore I would also say that it is not unusual for the market to get rich early into a cycle. And history tells us that when you have a 3 to 5 year, sort of positive cycle for the economy, the earnings growth that can come in that cycle is something the analysts can never capture. We pour rain on the analysts for not getting their forecast right over the last 6, 7, 8 years. I've been in this market for 25 years, 2003 to 2008. Every year the analyst said it is going to slow down, and it didn't. It just kept going. So, it's just the difficulty with forecasting, and we need to recognize that when we just look at valuations and take these calls on, what the market might do.
And if I may add to that, thank you, Vetri, that was wonderfully spoken. I totally agree. And I must say that no one really buys the Nifty, right? I mean, people buy stocks and sectors, right? So they take sector position. And I think that so far in the equity markets, everything has been driven by price to earnings, where companies that grow 8 to 10% a year and very stable earnings, they have all seen a sharp increase in price to earnings, right? So IT services, healthcare, consumer staples. Whereas as the market now starts to price in and starts to get into earnings growth, I think it would be preferable to get into sectors where earnings growth is going to be high and earnings upgrades are likely. And that would be banks, industrials, and sectors like that.
No, interesting point. Ignore the index, buy the value stocks. Thank you very much, all of you, for joining in on extremely well-rounded discussion. Just a few days to go now, so let's see where this one ends up. But I appreciate your time and your thoughts today. Thank you.
Thank you, Mitali.
Thank you.